Okay, lots to talk about in markets as investors react to some weak gross domestic product figures in the United States. Let's do so with Tim Pagliara. He's Chief Investment Officer with CapWealth, and he's joining us from Franklin, Tennessee. Tim, thanks a lot for joining us. First of all, what's your take on the market's apparent reaction to those GDP numbers of earlier this morning?
Well, I think it's predictable. I think the bigger number was the PCE, coming in at 3.6%. So it was a combination of both that I think, rattled everyone.
Okay, you say in some recent commentary that the volatility that investors have been grappling with so far this year is a move towards what you call more sustainable equilibrium on stock market valuations. Expand on that. Tell us exactly what you mean by that.
Well, for example, if GDP growth is negative or goes lower, then obviously the earnings of companies are going to decline or be stagnant for a time being. And so when you've got a market that's trading at 22, 24 times earnings, that is going to go up as earnings go down. So it's not a good situation. So you've got to realign earnings and PE multiples with what these companies are capable of delivering. And that's been a problem because of the concentration of earnings and investors in, let's say, the Mag 7, for example. I mean, Apple's still trading at 30 times earnings. Can they deliver that? I don't know. And certainly the environment we're in and all the different things that are surfacing, whether it's tariffs or inflation or general economic health, suggests that investors will reevaluate what they're willing to pay for these companies.
You also believe the market is not overreacting to all the economic uncertainty being generated by the White House's tariff policies?
No, I mean, let's use an analogy. If you'd been under the care of a physician for 4 years, and they had told you everything was great, and your physician retired January 15th. Now you got a new doctor, and he says your cholesterol's too high, you're diabetic, and you've got a lot of issues that we have to address. You don't blame the new doctor. You have a tendency to look in the past and look at what got us to this point. We have a $7 trillion worth of expenses. We've got $5 trillion worth of revenue, and $1 trillion of that revenue is devoted to interest on the debt. So we weren't any healthier this time last year than we are now. We're just finally addressing these issues.
Are you adding to positions in these lower stock markets?
Selectively, we have. We added a first-time position in DocuSign back during the big part of the volatility. Constellation Energy, we beefed up our holding in Fortinet. But generally, we're holding non-correlating assets in our accounts, whether it's United States Treasuries or other special situations. We're non-correlated to the market by 40 to 50% of our holdings right now.
Does that include gold, those non-correlated assets?
No, we don't own any gold. It's just special situations that, we believe in. For example, the GSEs, Fannie Mae and Freddie Mac, we believe that the dynamics of what is happening right now is going to force their hand to monetize the government's interest in these companies, get them back to the private sector, have them make a positive contribution to boosting GDP through solving the shortage of workforce housing. The government can monetize a $300 billion interest in that. So it's things like that we're doing that really have little or no impact on the market.
Okay, let's go to some stocks that you like. You mentioned DocuSign. Tell us more about why you established a position in DocuSign.
Well, we think they've turned the corner on the things that are important. Revenue profitability, and they're being embedded into commerce. Try and open an account at Charles Schwab without DocuSign, or try and do a loan document now with a bank without DocuSign, or a closing for a real estate transaction. So they have a long runway, and we believe that that is a great company that is going to have a very large addressable market in front of it.
You mentioned Fortinet as well. That's, of course, one of the big names in cybersecurity. Why do you like that stock?
Because they're extremely well run. Fortinet owns more patents in cybersecurity than any other company in their industry, and they are providing a solution. From when you walk in the door, for example, and you've got to manage your Wi-Fi networks, to a fully integrated security package. So we believe they've got a lot of growth in front of them, and that's driven by the market for, the need for cybersecurity.
Let's go to UPS. That company has been in the news recently. It's one of the latest of the S&P 500 companies that is telling investors we don't know enough about the macroeconomic environment moving forward to reliably provide guidance. So it withdrew its guidance yesterday along with General Motors. And you're in this stock as well.
Yes. And, UPS is a company that has demonstrated their ability to navigate economic turmoil for a long, long time. And so they will get it right. They will be impacted. But at current valuation, it's somewhere around 14 times earnings, plus or minus, with a nice dividend approaching 7%. And we believe that's sustainable. And they will do the things that they have to do, whether it's laying off 20,000 employees like they announced or whatever. They will retain their profitability and figure out a way to make money in the current environment.
Tim, thank you so much for joining us. That's Tim Pagliara. He's Chief Investment Officer at CapWealth. He joined us from Franklin, Tennessee.